Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Mattel.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so we have to address the elephant in the room. Or maybe the shattered dollhouse in the room.
It's definitely a bit of a mess in the toy aisle today.
Bit of a mess. We are recording this on Wednesday, February 11th, 2026. And yesterday, Tuesday the 10th, Mattel stock didn't just stumble. I mean, it fell off a cliff.
It really did.
We're talking a slump of, 28% in extended trading? That is just a massive move for a legacy blue-chip company.
It was a violent move. There's really no other way to describe it. It's the kind of drop you usually see with a biotech penny stock that failed a drug trial, not
Right.
a company that owns Barbie and Hot Wheels.
Exactly. And when you see a household name lose nearly a third of its value in a single session, you have to ask yourself, is the house on fire here? Is this a total disaster we need to run away from? Or is this what the pros call a capitulation low?
And that is the core question we are answering today. Is this a falling knife that will just cut your hands off, or is it the sale of the decade?
Right.
Because when everyone else is panic selling, that's often when the smartest wealth is made. But, only if the thesis holds up.
So let's put on our detective hats. Take us to the scene of the crime. What actually happened with these Q4 earnings to trigger such a massive sell-off? Because usually bad earnings might get you a 5, maybe an 8% drop.
Sure.
28% feels personal.
It does feel personal, but the headline numbers were, they were undoubtedly ugly. Mattel reported fourth quarter 2025 net sales of $1.77 billion.
Okay, 1.77.
Now, Wall Street, the analysts who build these, complex models, was expecting $1.84 billion.
So right off the bat, that's a clear miss on the top line.
A very clear miss. They moved less product than expected during that critical holiday window.
Which is the Super Bowl for toy companies. If you miss Christmas, you've basically missed the entire year.
Precisely. And that sales miss, it trickled right down to the bottom line. Adjusted earnings per share, the EPS came in at 39 cents.
And the estimate was?
The analysts were looking for 54 cents. That is a massive whiff on profitability. We aren't talking about missing by a penny here. That's a 27% miss on profits.
Okay, missing by 15 cents on the dollar is painful. But I want to understand why. Was this just nobody wanted Barbie? Or was there something else going on in the broader economy?
It wasn't that nobody wanted the product, per se. The report highlights that the environment was just incredibly difficult. First, there was really heavy promotional activity in December. Basically, to move inventory, retailers forced price cuts. And when you slash prices just to clear the shelves, you are eating directly into your profit margins.
Right, so you're selling the toy, but you aren't making nearly as much money on it.
Exactly. And secondly, the broader context is the U.S. consumer. The report explicitly stated the consumer base is growing less than expected. People are just being tighter with their wallets.
We've seen that everywhere.
We have. Across the retail sector, but it seems to have hit toys pretty hard this quarter.
That makes sense.
Yeah.
But again, I keep coming back to the size of the drop. 28%. Markets usually look forward, not backward. Was there something in the forecast that really scared people?
You hit the nail on the head. That market reaction wasn't really about the past quarter. It was all about the future. It was about the guidance.
Okay.
Management explicitly labeled 2026 as a costly transition year.
Oh, investors hate the word transition. It's corporate speak for, we're going to spend a lot of money and not make much profit for a while.
Exactly.
It just introduces uncertainty, and Wall Street hates uncertainty more than anything else.
And they proved it.
Yeah.
So they issued guidance for 2026 EPS of somewhere between, say, $1.18 to $1.30.
And where was the street before this?
Well, keep in mind, before this report dropped, the street was expecting $1.75.
Wow. So they basically told Wall Street, hey, that profit you thought we were going to make next year, go ahead and cut it by about 30%.
That's it. They are resetting the bar significantly lower. And to make matters worse, they dropped a bombshell about their biggest icon. They stated that the Barbie brand is not expected to return to growth until 2027.
2027. That feels like an eternity in this market.
Yeah.
So Barbie is essentially taking a gap year.
In terms of growth, yes. They're taking a very, very conservative stance. So you combine a massive earnings miss, a huge slash in future profit guidance, and a pause on your flagship brand.
And you get a 28% drop.
That's the recipe.
Okay, so that's the bear case. It's bleak. The sky is falling. But
Yeah.
We are here to find the smart wealth. We need to look through the rubble. Was there anything in this report, any little nuggets of information that suggests the market is overreacting?
Yes.
Because sometimes when management clears the decks like this, they're setting up for an easy beat later on.
Actually, yes. There is quite a bit of hidden strength here if you look past the headline disaster. And interestingly enough, it starts with the garage, not the dollhouse.
The garage, you mean the vehicle segment?
I do. The vehicle segment was a huge, surprising bright spot. Despite all the gloom in the general market and the weak consumer, Hot Wheels posted double-digit growth.
Double digit in this economy. That's really impressive.
It is, and it wasn't just Hot Wheels. Matchbox performed well. Even the lines connected to Disney and Pixar's Cars franchise were solid.
Okay.
And this is crucial because it proves that the core intellectual property, the IP, it still works. Kids still want these toys. The brand equity hasn't evaporated, it's just shifting categories a bit.
That is a really interesting psychological point. You know, a $1 Hot Wheels car is a much easier purchase for a stressed parent than a $50 dream house.
Of course.
It's an impulse buy versus a major investment, so the core engine is still running. What else did you find?
The second piece of hidden value is their digital strategy. We need to talk about Mattel 163.
Mattel 163, that's their mobile gaming joint venture, right?
It was. But as part of this whole transition they keep talking about, Mattel is acquiring the remaining 50% of that company for roughly $159 million.
Okay, so they're spending money, but what does that actually get them? Why is this good news?
It gets them full control of a high-margin revenue stream. This acquisition is expected to add about $150 million in revenue in 2026 alone.
Okay.
But the key here is the type of revenue. This moves the company away from just being a physical manufacturer where you have to worry about plastic prices and factories and shipping containers, and moves it toward digital gaming.
Which has much, much better profit margins.
Yeah.
If you sell a digital card back or a skin in a game, your cost to produce that incremental unit is basically zero.
It's almost pure profit.
Yeah, compared to manufacturing and shipping a toy truck across the ocean.
Exactly. This is what we call operating leverage. Once you build the game, every extra dollar you bring in drops straight to the bottom line because you don't have those variable costs tied to plastic and logistics. It's a structural shift in their business model that the market is currently ignoring.
Because they're too focused on the short-term earnings miss.
Right. They are trading lower margin physical sales for higher margin digital sales.
Speaking of shipping containers and physical goods, I remember a few months ago, everyone was terrified about tariffs. With the geopolitical climate, the consensus was that tariffs would just crush toy companies because they rely so heavily on imports. Did they address that on the call?
This might be the most impressive operational win in the whole report, and almost nobody is talking about it.
Oh.
Management confirmed they have fully offset the impact of U.S. tariffs.
Fully offset? That seems impossible given the numbers people were throwing around.
Fully. We're talking about an estimated $270 million impact. They managed to neutralize that completely through supply chain diversification.
So moving manufacturing around.
Moving manufacturing out of tariff-heavy zones and through product optimization.
That is huge. I feel like that got totally buried in the bad news. If they hadn't done that, this earnings report would have been a catastrophe, not just a miss.
It would have been a disaster.
It shows management actually knows how to run the logistics side of the business incredibly well.
It removes a massive bear case argument. If you were shorting Mattel because you thought tariffs would wipe out their profit, you just lost your main thesis. They fixed it.
Okay, so let's recap these hidden positives. We have a strong vehicles segment, showing the brand is alive, a shift to high-margin digital gaming with better operating leverage, and they've bulletproofed the supply chain against tariffs.
Right.
But the stock is still down. What is management saying about the stock price? Actions speak louder than words, right?
They are shouting with their wallet. They announced a $1.5 billion share buyback plan that runs through 2028.
$1.5 billion. Let's put that in context for everyone. For a company of this size, that is a massive chunk of the float.
It's huge. The float is just the number of shares actually available for trading by the public. When a company buys back its own shares, it takes them off the market. It retires them.
Right.
This means the remaining shares, the ones you or I might hold, represent a larger piece of the company. It increases the earnings per share simply by reducing the number of shares the earnings are divided by.
So it's basically engineering growth for The shareholders who stick around.
Correct. And companies usually only do this when they believe the market has undervalued them significantly. It is the ultimate insider signal.
Yeah.
They're looking at this 28% drop and saying, fine, if you don't want the shares, we'll take them.
That shows real confidence. They aren't hoarding cash for a rainy day. They're deploying it because they think the stock is cheap.
And despite the sales miss, they are still financially efficient. Their return on equity is sitting at 20.60%. Their net margin is over 8%. This isn't a company bleeding out.
It's profitable.
It's a company that is profitable, just less profitable than the optimists had hoped for in the short term.
Okay, let's pivot to the future. Because you mentioned 2026 as a transition year. A transition to what? We know they had huge success with the Barbie movie in 2023. It was a cultural phenomenon. Are they just trying to do that again?
That is exactly the plan. We call it the Hollywood strategy. They are trying to transform from a toy maker into an IP powerhouse. And the calendar for 2026 is actually stacked.
They're betting the farm on the box office.
Essentially, yes.
Okay, walk me through the premiere schedule. What are we buying tickets for?
First up, coming in June 2026, is the live-action Masters of the Universe film.
He-Man. By the power of Grayskull. That brings back memories.
Exactly. But this is the first major test post-Barbie. Can they take a different franchise, one that appeals to a whole different demographic, and make it a cultural moment?
That's a big swing. Action movies are expensive to make, and if they flop, it looks really bad.
They are high risk. Then in October 2026, we have a Matchbox movie coming to Apple TV.
Interesting. Matchbox is usually the more serious car brand compared to Hot Wheels.
Yeah.
A streaming movie seems like a safer, more strategic play compared to a massive theatrical release.
It keeps the brand in front of kids without that massive theatrical risk. But they also have a Barbie animated film and a Hot Wheels live-action movie planned for the year.
Wow, okay.
And looking even further out into 2027, they start a multi-year licensing deal with Paramount Skydance for Teenage Mutant Ninja Turtles.
Oh, the turtles never go out of style. That's a cash cow.
So here is the analysis. The risk-reward profile here is tied directly to these screens. If Masters of the Universe hits in June, or if the Matchbox movie drives toy sales in Q4, the earnings for 2027 could absolutely skyrocket.
And if they flop?
Then the strategy is in trouble. However, notice who they are working with: Paramount, Apple TV, Netflix.
Right.
They aren't trying to be a movie studio by themselves. They're partnering with the best in the business. This reduces their execution risk significantly compared to trying to do it all alone.
So they provide the IP, the studios provide the filmmaking expertise and distribution, Mattel sells the toys and takes a cut of the box office and licensing fees.
Exactly. It's a high-leverage model. When it works, like it did with Barbie, it just prints money. It turns a toy company into a media company.
So let's talk about how the street is reacting to this Hollywood strategy. The stock crashed, so obviously people sold. But what are the analysts, the people who cover this for a living, saying now? Are they telling everyone to get out?
Surprisingly, no. Most analysts are in neutral territory. Firms like Roth MKM and JP Morgan Chase have neutral ratings. They aren't in panic mode.
They're in wait-and-see mode.
That's it. They're in wait-and-see mode.
That's a big distinction.
Right.
Panic mode means this company is broken. Wait-and-see means show me the movie ticket sales.
Exactly. And this brings us back to that theory of capitulation. I would argue that a 28% drop on a guidance miss is likely an emotional overreaction by the market. Think about it. All the bad news, the transition costs, the weak consumer, the Barbie pause, it's all out in the open now.
It's priced in.
It's all priced in.
I want to dig into that word capitulation for a second. We hear it a lot in finance. What does it actually look like in practice?
Capitulation is the moment when the last optimist gives up. It's when the investors who are holding on, hoping for a turnaround, finally look at the earnings report and say, I can't take this anymore, and they sell at any price.
It creates a vacuum.
It does. The sellers have washed out.
So the selling pressure just exhausts itself.
Yeah.
If you are holding Mattel for a quick buck, you're gone. You sold yesterday.
Right. Who is left holding the stock? The long-term believers and the value investors who see this price as a bargain. This creates a floor for the stock price. The weak hands are out and the strong hands are accumulating.
But we have to be clear with our listeners. This isn't a get-rich-quick trade for next week. You're not buying this for a bounce tomorrow.
No, absolutely not. This is not a quick flip. If you are entering here, you are looking at a 12 to 24-month horizon. You are treating this as a swing trade, targeting that 2027 inflection point. You are betting that the transition actually leads somewhere and isn't just money down the drain.
Which brings us to the risks. We can't paint a rosy picture without looking at the dark clouds. What could go wrong here?
The biggest risk is the macro environment, the
Yeah.
U.S. consumer. If the economy dips into a full recession, people stop buying toys. Period.
Yeah.
Even the conservative guidance of $1.18 EPS might be too high if parents literally cannot afford Christmas presents.
Right. Toys are discretionary. You buy food and gas first. He-Man comes second.
And the second risk is just execution on the entertainment side. Replicating the cultural phenomenon of the Barbie movie is incredibly difficult. Lightning rarely strikes twice.
True.
If Masters of the Universe gets bad reviews and flops at the box office, it hurts the stock and it hurts the toy sales.
Yeah, a bad movie can actually damage your brand. We've seen that happen with some of the superhero franchises recently.
It can. So the strategy really hinges on these movies actually being good.
So let's wrap this up. Let's pull all these threads together for the listener. We have a massive drop, a company pivoting hard to digital and movies, and a solid buyback plan. What's the verdict?
I view Mattel right now as a hidden transformation story. To the casual observer, it looks like a toy company having a really bad quarter.
Sure.
But if you look deeper, it's an IP company that is investing heavily sacrificing short-term profit for a potential boom in 2027.
So you're saying the pain is temporary, but the plan is solid.
I'm saying the 28% decline offers what we call an asymmetric risk-reward.
Break that down for us.
Asymmetric risk just means the potential upside is significantly larger than the potential downside. The stock has already crashed, a lot of the downside is realized, the bad news is known.
Uh-huh.
But if the movies hit and the digital gaming grows, the upside is substantial. It's like betting $1 to win 10.
But you have to be patient. You have to be willing to sit on your hands and wait for that movie slate to play out. It's a fascinating setup. And I want to leave you, the listener, with one final thought. Everyone is focused on the numbers from last quarter. But the real spark might be in a movie theater in June. If Masters of the Universe surprises people, if it becomes the summer blockbuster, sentiment on this stock could flip overnight. We've seen it happen before. The question is, do you want to buy your ticket before the reviews come out or wait in line with everyone else?
That is the question.
Thanks for breaking this down. This was a wild one.
Always a pleasure.
And thank you all for tuning in to this analysis of Mattel. We hope it helps you make sense of the chaos in the markets.
If you enjoyed this, make sure to check back tomorrow.
Just a standard reminder that this is for informational purposes only. Do your own research, and we'll catch you on the next one.